This is Stacy, and I'm Amanda from BND. Whether it's loans or credit cards, compound interest is an important thing for you to understand. It drastically changes the amount that you owe.
Compound means it's made by combining two or more parts. In English, we have compound words like sunflower. But when it comes to financing, compound means to combine principal and interest. Compound interest is when a lender adds the unpaid interest to your principal balance. That causes the amount you pay interest on to grow.
How often a lender compounds the interest ranges from daily to annually, and this information is outlined in the terms and conditions of each credit card or loan. Let's take a look at an example. Say you charged $1,000 on your credit card and that your APR, or annual percentage rate, is 15%. Some credit card companies will compound the daily interest, so when you have a balance, you'll have to figure out that daily rate or how much interest is being added to your balance each day. You have to divide your APR of 15% by 365 days in a year. While that doesn't sound like much, it adds up. In this example, your balance goes from that $1,000 that you charged to $1,012.40 after 30 days. The credit card company will only charge you the interest if you don't pay your balance in full by the due date.
What happens if you are unable to pay the $1,000 by the due date? You are charged the interest and will have a larger amount to repay. Here's what your balance would look like if you paid $50 and do not make any other purchases over the next 30 days. You should do your best to budget and avoid carrying over a balance month after month. If you can't pay the balance in full, make sure you pay at least the minimum amount due as much as you can by the due date to avoid any late fees.
The same thing happens with student loans because people typically take loans out for more than a year and don't start repaying until after they're done with school and their 6-month grace period has ended. If you take out $5,000 for each year of college for 4 years and don't pay anything off along the way, you will have unpaid interest on your account, which is added to the principal balance. Your interest will compound and you'll be paying interest on interest.
What if you make payments while in school? Let's take a look at what your balances and future monthly payments would look like if you made no payments, made $20 payments per month, and paid all of your interest over the 4 years.
Understanding how interest can make a difference when you're repaying debt is so important, and making informed decisions early on will help you budget later. Learn more about budgeting and other financial topics by visiting Bank of North Dakota's College Handbook at collegehandbook.bnd.nd.gov.